This video will cover the residual income model. We'll define residual income and motivate its use in valuation of common stock. We'll employ the residual income model in examples, and we'll compare and contrast it to the dividend discount model. I strongly recommend that you watch the previous video on the dividend discount model before you watch this video. I'm going to leverage the material on the dividend discount model here. Probably the best way to start and motivate the residual income model is to actually look at the formula to see where we're going. Okay, this is an estimate of the stock price today, just like we've seen before. Time zero stock price. You could put a little hat on there, but I'm not going to bother. We know it's an estimate. Then this is book value per share at time zero. I'll explain why we're doing that in a minute here. And then we have earnings per share at period one. Okay, at time period one. So you basically have a timeline, price right here, time zero. This is, and also book value at time zero. And then time one, you get the earnings per share that cover this period right here. So that's the earnings per share. This is required earnings per share. And required earnings per share are equal to book value times K. The discount rate, the same K here, it's the discount rate that we used in the dividend discount model and comes from the security market line and the capital asset pricing model. Remember that line where we said, look, here's the intercept, which is the risk-free rate. This is the expected return, or K, the required rate of return given the risk, and beta measures the amount of risk you have. And we had this line, and the line was the expected return on a security equals its required return when you're in equilibrium, and that equals the risk-free rate plus beta times the expected return on the market minus the risk-free rate. That's what we covered in the previous video, just to give you a little background again. And then G is growth. Now, what are we discounting and what are we growing here? Well, as soon as you see K minus G, that should be very reminiscent of the constant growth rate model, constant dividend discount growth rate model that we did in a previous video, where we had an estimate of the stock price today is equal to the dividend. I should have DPS, but it's the dividend per share for period one divided by K minus G, assuming constant growth forever. So that was constant growth forever in dividends. This is constant growth forever in this numerator up top here. It's the difference between your actual earnings per share and what's required given its risk. So remember, K is the required rate of return on the stock given its risk. So the point is, this is going to be positive. This numerator is going to be positive if you earn more than what's required given the discount rate here. So what it's saying is you need to cover, in order for the stock price to be attractive, this to be high, you need not only an initial book value, which, like I said before, I'll get to in a minute, but you also need this difference to be really big to be attractive. And then you want to grow it out to infinity. So you want to have earnings that exceed your cost of capital, because your earnings per share, this EPS one, that has all of your costs except the cost of equity, because you can't expense dividends. So dividends don't show up on the income statement. So how do we reflect that cost of capital? It's right here through K. So another way to look at it would be this. Basically, you have a balance sheet. I always go back to the balance sheet. Assets, liabilities, equity. And if you put this whole thing on a per share basis, this equity component is book value. So you want your book value, your equity, to grow at the discount rate, K. So if this is 10% and you have a book value here of, let's say it's $10, you want earnings per share to be $1, because if you require 10% and you actually have assets minus liabilities, equity equal to $10, then you should be earning required earnings per share should be $1. So what are we doing here? What we're doing here is we're looking at, look, here's the stock price today. It equals the book value today. And if we had no residual income, this numerator is 0. In other words, you're earning exactly what you're required. This would be 0. This whole thing disappears, and the price of your stock equals the book value, which is exactly what I'm telling you in a sense here. This is, you can look at the book value here, and that would equal your stock price also. So another way to interpret this equation is to say that, look, we're computing the present value of residual income, plus on top of it, what are the value of your assets existing right now? So this is the value of your assets existing right now, right? Minus your liabilities on a book value basis, your equity. This is the value of your equity with assets in place. This is going to be your residual income, your extra income above and beyond required. So the price of a stock is equal to your equity in place right now, your assets minus your liabilities, plus the present value growth of residual and reflecting growth of residual income. Now, let's go to an example and make it more clear. Suppose Bill's Bakery expects earnings per share to be $2.56 next year. $2.56, current book value. Okay, that's the assets minus liabilities divided by the number of shares is $4.70. The cost of equity is 11%. Cost of equity, 11%. Calculate the share price for Bill's Bakery if earnings grow at 3% forever. In other words, if residual income grows at 3% forever. So, P subscript 0 is 470 plus the 256 minus the 470 times 11%. So this is what you're going to need just to cover your cost of capital. And then remember, this order reflects all your other costs and revenues combined. And there we have the 3% growth rate. This stock price is $30.24. So you got a roughly $26 associated with residual income, the present value of residual income, all the way out into the future, discounted back. So this is the present value of residual income, assuming a constant growth rate of what? Of residual income, this numerator. That was basically a plug and chug example. Not a whole lot of intuition, a little bit, just to get you comfortable with it. All I did was I showed you a formula, gave you a few numbers, and we just shoved the numbers into the formula. Came out with $30.24. Let's apply it to something a little more interesting. Let's go back to the model that we looked at using the constant growth and dividend model. Remember, I built this table. So I built this table, and here was the background for the example. I said, look, K is the discount rate. It's the required rate of return on the stock given its risk, which equals the return on equity in this particular example, and it's 15%. So basically, what you require on the stock is what the firm is earning, and that's 15%. We said, look, earnings per share at period 0 is $2. The payout ratio is 50%. For every buck the company earns, it pays 50% out on a dividend. They said this information implies the growth rate of 7.5%. And what we did was we just compounded things out basically in this table. Started out with the $2 earnings per share and grew them. Actually, we went this way through the table, but you can go down this way also once you understand the intuition that this and this and this are growing at 7.5%, that constant growth rate. Okay, so that's constant growth in dividends. And so we estimated this stock price right here. We estimated it using this formula. We took this dividend. We said 15.15 minus the 7.5% gave us 14.33 for this particular stock. Okay, so that's just some background information. Now, what if we were to apply the residual income model to this same data, and everything's going to stay the same. So I just got a fresh piece of paper because I'm going to do some calculations and I need some space. But what we want to do is estimate the residual income model. Remember, the formula is this. So now let's get started and actually put some of the numbers in and see how far we get on this now. Okay, we estimated the stock price to be $14.33. We don't know the book value yet. We know earnings per share period 1 is $2.15. That's right here. We know required earnings per share is book value times K. So that's interesting. Okay, we still don't have book value yet. We know what K is. So at this point, we can say, look, this is 0.15 minus 0.075. But we have this problem. Given the information so far, I don't have any obvious book value at time 0. Well, let's look at the problem a little more closely. Maybe there's more information in there than we think. Well, let's see. If K is equal to the required rate of return at 15%, and it's equal to return on equity, that means this company, this firm, is growing its equity at 15%. We require 15%. So therefore, earnings per share and required earnings per share are the exact same number because we require, given the discount rate, the same as what it's earning. Therefore, this has to be equal to 215. And we know this is 0.15. And so book value, if you think about it now, 0.15 equals, how does that equal 215? This is basically an X here. Well, the book value has to be 14.33. And so book value is 14.33. Let me plug it in here, different color. Right? And this is 14.33. Then it works because what happens is our residual income in this example is 0. Each year it's 0 because this firm is earning exactly what's required. And so with just, sleight of hand, we can back in and deduce the fact that this company has a book value of 14.33. So firms that earn a return on equity that's equal to the discount rate have no residual income. And so the present value and the growth of that residual income, if you try to grow 0, it doesn't go anywhere. So that's how we got to this answer. Now, the really interesting question is, what if we break this connection now? We said that K was 15 and return on equity is 15%. Why don't we leave everything the same here as far as what's growing in the business, but change K? Let's change K to 10% instead. What happens to the stock price? Again, let me clean this up. It's getting messy. Got a table built right here. We have K equal to 15% for this stock price. Going back to the previous video and what I just covered, now I want to estimate P given, I shouldn't put subscript 0 because it's only subscript 0 for this one time. This is P1. Let's do K 10%. What does that mean? That means, well, we expect a lower discount rate. Our required rate of return on this stock is less. Somehow we looked at this stock and we now suddenly think that it should only be discounted at 10% because it's less risky. So K, remember, measures risk. So this 15% implies there's more risk than this 10%. So let's try the discount rate with 10%, assuming that we're anchored right here. So what's happening is you bought the stock. We're going to have to assume here we valued the stock right at this point in time, right here, time 0. And now, seconds after we did that, suddenly we view the company as being less risky, or the market views the company as being less risky. And so now let's calculate the price according to the residual income model. Well, we still have the 1433 because that's book value, because these two numbers are equal here, the K and our return on equity. Plus, we still have So remember, I'm keeping all this the same right here. Okay, so we still have 215 in actual earnings per share, and now we have book value times 10%, and this is $14.33. So this has to be $1.43 divided by 0.10 minus 0.075, the same growth rate. We didn't change the return on equity. This is return on equity right here. We didn't change the payout, so the growth is still 7.5%. Now, let's estimate this. It's going to be 1433 plus, so this equals 2880, and in total is 4310. 43.10. And what we're saying here is that the residual income component, the present value of residual income going way out into infinity, is $28.80. It's basically 2/3 of the value of this stock. 2/3 of it is tied up in this residual income. And so that tells you something, because this is the base book value. And what it's saying is, look, 2/3 of your value is based on hopes that this company has residual income, continues to have residual income that grows at a constant rate of 7.5% forever. So it's insightful to decompose the stock price into its book value and the present value of residual income. It's interesting to note that if we use the dividend discount model with constant growth forever, let's see if we get the same result. This is 1075 divided by 10% minus 0.075. This is $43 exactly, because I have some rounding. I rounded here, so there's a little bit of rounding. So it's basically this number right here. So all I did was I took the same dividend discount model we had applied to calculate this, but this was with a K of 15%. Now I put 10% in, left the growth the same, left the dividend the same, because like I said, nothing here changed. All I changed in this example was I changed K, the required rate of return in the stock market. So the business can operate. One of the other points that's interesting about this is the firm can operate and go on its merry way and keep earning 15%, and investors can increase or decrease their K over time. You know, if they think the firm is riskier, they drive up K. When K goes up, prices go down. And when K goes down, prices go up. That inverse relationship between discount rates and prices. So you see that in this model. So what did we just learn from this example? Well, one, we learned that some of these problems are not simple plug and chug. You got to do some deductive reasoning. You can back into the results, but you have to kind of, you got to have a good understanding of how the models work. The other thing that we learned is, look, this residual income model is perfectly consistent with the dividend discount model. Perfectly consistent, except for a little bit of rounding that I had. The models are consistent. Well, they should be. If you have the same assumptions in one model to the next, you better get the same results, or something's wrong somewhere. Either you have a flaw in the model, you made a mistake, you got substantial rounding error. Somewhere there's a problem if you have the same assumptions but you come up with different results. That's an important point to common stock valuation, because there's multiple ways of getting at a stock price and estimating it.